Good afternoon, everyone. Welcome to another weekly trading insights session with TradingLink. This week marks the final trading week of November, coinciding with Thanksgiving in the United States and the third trading week since Trump's election. This week's market movements have been relatively limited, finally recovering from the intense volatility of previous weeks and settling into a plateau. The main market movement this week occurred on Monday. Crude oil experienced a sharp decline, influenced by peace negotiations related to the Israel-Hamas conflict. From Tuesday to Friday, crude oil remained in a narrow low-range fluctuation, with trading activity particularly subdued due to the U.S. holiday yesterday. We're focusing on crude oil today because, originally, an OPEC meeting was scheduled for this weekend. However, the meeting has been postponed to Thursday. Within OPEC, there are significant disagreements on whether to cut or increase production starting in the first quarter of January. In recent months, crude oil has been affected by a subdued environment. Its trading range has been between $66 on the lower end and $72 on the upper end. Weekly effective fluctuations have been limited to $2-3, a rare occurrence in crude oil's history. A similar situation was observed at the end of 2022. Regardless of the outcome of next Thursday's meeting, we believe it may create short-term bearish pressure on crude oil. There's a significant chance that crude oil may break below the previous annual low of $66, leading to further downward pressure. The next key support level may be around $60. The next significant support could potentially break further. Therefore, it's crucial to avoid building short-term long positions in crude oil. If crude oil breaks below $66, there's a high likelihood of rapid downward movement on Monday through Thursday next week. Additionally, should market news exacerbate the situation, further aggressive declines are possible. If crude oil falls below $65, the next support level may align with the double bottom seen in August and December 2021, approximately around $60. The starting point in April 2021 was also around $60. Thus, there's a high probability that crude oil could drop to $60 in this round. Weekly charts from previous weeks indicate that all moving averages, including midterm weekly averages, are trending downward. In such a market, the underlying bearish trend, once triggered, could result in rapid and intense declines, potentially causing significant losses. Gold also experienced a sharp drop on Monday this week. This bearish movement was primarily influenced by peace negotiation talks, triggering rapid liquidation of long positions. Last week, the consecutive 5-day uptrend served as a squeeze and washout for short positions. Many clients attempted to short the market during the Monday to Thursday uptrend, only to face losses when bearish pressure emerged on Friday. They are now concerned about further rallies next week. On Monday, a rapid liquidation occurred, with the timing of this bearish movement being particularly awkward. During the Asian session, at around 11:30 a.m. China time, there was a sharp drop of approximately $40 within a short period. At 11 a.m., during the hourly close, another rapid bearish attack occurred. These two waves of decline resulted in significantly high trading volumes. Essentially, all the profit positions of last week's longs were wiped out. A gradual rebound followed, but next week presents considerable risks. There is a potential for the formation of intense candlestick patterns. Once lower wicks form, investors might believe the bulls have stabilized. However, if another surprise bearish candlestick appears, the losses for long positions could escalate significantly. Regarding non-US currencies, as mentioned last week, a weekly level correction was anticipated. After 3 consecutive weeks of upward movement, a divergence at the weekly level has emerged. It has also reached the 108 psychological level and the upper band of the weekly Bollinger Bands. This minor correction, being a technical adjustment, could significantly impact retail investors and profit positions from last week. Those who didn't lock in profits last week might find themselves in an unfavorable position now. However, the long-term outlook for the US dollar remains optimistic. Over the long term, including next week, a return to the ascending channel remains promising. Finally, let's analyze Bitcoin. We anticipated a favorable pullback midweek. Over the past 3 days, Bitcoin has surged rapidly again, reaching $91,000. Currently, the overall trend is strong, as evident from the extremely long lower wicks on the weekly candlesticks. Starting next week, the 5-week moving average will exceed the $50,000 level. Thus, Bitcoin is expected to sustain this trend in the coming weeks. After 2 weeks, As the moving averages converge, another surge is likely. Similar to the rapid rally of recent days, the past 3 weeks only required a few trading days for an initial surge followed by consolidation. Therefore, the overall Bitcoin market outlook remains bullish. For spot investors seeking long-term holdings, building or adding to positions is advisable. However, avoid chasing high-level contracts, as a washout caused by extended lower wicks could lead to long position liquidations. That concludes our weekly review and summary. At TradingLink, as we approach the Christmas season, many traders have already reduced their positions. Some funds have also completed their annual position closures and settlements. However, our recruitment of traders continues actively. We also hope more trading institutions will entrust accounts to us, collaborate with us on technology, and take on more trading capital. Next week's trading opportunities may be limited, as December, being the traditional final month of the year, tends to have lighter trading activity. Market volatility might also be constrained. Year-end profitability is no longer our primary focus at this stage. Let's also discuss the notable stabilization and rally observed in the past. On the weekly chart, the 10-week moving average might cross above the 5-week moving average next week. The high-level consolidation phase, lasting approximately 8 weeks, seems fairly mature. There is still a chance for the index to close the year, quarter, and month above 3,600 within this high-level range before year-end. Some investors have asked about our strategy for shares. However, our team does not trade in shares. We specialize in leverage markets. This concludes our analysis and planning for this week. We encourage everyone to manage their positions carefully and prudently mitigate trading risks in the market. That wraps up this week's analysis and summary. Let's reconvene next week for further discussions.